Please welcome Vishal Kankani, Principal at Multicoin Capital, and Guy Young, CEO and founder at Ethena Labs.
Hi, everyone. We have Guy Young, founder of Ethena Protocol, who most of you know here. But Guy, for people who don't know about Ethena, can you tell what Ethena is, what's your founding story, and why did you decide to do this?
Yeah, for sure. And great to be here with everyone. So yeah, my name is Guy Young. Before founding Ethena around 2.5 years ago now, I used to work in traditional finance. Worked at a large distressed hedge fund that was based here in New York. The origin story was actually an article that Arthur Hayes, who founded BitMEX a few years ago, put together, where he kind of put out a call to action for someone to come and build what he viewed as one of the largest opportunities within the space, which was to create a crypto-native dollar-pegged asset that could exist and perform different functions that sat alongside assets like you see, like USDT from Tether. So I quit my job kind of at the bottom of the bear market last cycle. It was just after Luna had collapsed, and then FTX shortly after that. And yeah, we came out with the first product around 18 months ago now. That product scaled from zero to peaking at last month around $17 billion. So just to give you some perspective in terms of where that sits relative to the market, we crossed $10 billion, twice as fast as Circle and 4 times as fast as Tether. And I think the proudest achievement that we've achieved is actually, I think it's the first portfolio company that Multicoin has invested into that has the word ETH actually sitting in the title.
Well, you did not tell me when we did that. Maybe that would have changed.
Yeah.
Just kidding. Well, cool. That's impressive. Like, Ethena, for people who don't know, is the only stablecoin-related asset who has managed to escape and challenging, at least starting to, a duopoly of USDC and USDT, the 2 big stablecoins. So that then begs the question, like, Guy, do you think Ethena competing directly with Tether and Circle? If yes, how do you plan to compete? If no, like, we recently released a report which people got in the homework about synthetic dollars. So can you help us place Ethena in the stablecoin space and synthetic dollars, and what does that mean?
Yeah, for sure. So I think they are fundamentally quite different products, and I think stablecoins can serve different functions, have different use cases, and we can serve different niches. So a payment stablecoin, as defined by the Genius Act, as you've seen in the US, can look very different to a savings account. So if you're trying to create a savings account that generates a yield that anyone on earth can access, that's obviously going to look quite different to something they're using to pay every single day. And so we sort of see multi sort of use cases for stablecoins and individual winners who will be able to win each category based on the way that they're sort of positioning their product and going to market. The interesting thing or uninteresting thing about stablecoins, I think, is that they're extremely commoditized products, and actually the Genius Act makes them even more commoditized because there's a very prescriptive way in terms of how you have to design them. And when you have extremely commoditized products, the question is, how do you as a startup go and compete with businesses that are valued at $500 billion as of a couple of months ago? And if you look at a stablecoin, there's only really 3 axes that people can actually try and compete. So you need to be stable and at $1, and if you're not doing that, you're out of business pretty quickly. You need to be liquid, and that's a huge part of how these businesses sort of compound the network effects around their products. And as a startup, again, it's very difficult to be more liquid than something that's trading $100 billion a day. And then the final axis is return or yield that's actually generated within the product. So the insight that Ethena had was basically that yield axis is the way that you can try and compete. And there are very specific use cases where having a structurally higher return on your dollar asset versus an asset like USDT or USDC that doesn't pay you any yield actually enhances the product and makes it better. So whether it's providing a savings account for people that exist outside of the US, financial rails, whether it's collateral use cases, so if you're trying to trade on an exchange, being able to get paid on your collateral while you do that is obviously incredibly important. And I think the analogy here is actually just thinking about traditional finance, where USDT and USDC kind of resemble cash, which is it has no yield, it has no sort of function as a collateral base within finance. But actually all of finance kind of runs on T-bills and fixed income, right? So if you look at the balance sheets of insurance companies, of banks, these businesses and entities aren't just holding cash, which is kind of what USDC and USDT are. They're holding fixed income instruments. They're actually generating a yield of which they're building a business upon. And that's how I sort of think about Athena's product and asset, which is really being that kind of fixed income instrument that the whole of DeFi and CeFi within crypto can sort of rebuild itself on.
Thanks. Two massive things happened this year, which could have put you out of business. The largest crypto hack in February, $1.4 billion, with one of your major partners, Bybit, right? And the second just happened on October 10th, the largest single-day liquidation that crypto industry has seen. And you, like being so close with perps and centralized exchanges executing your strategy, I mean, I'm sure there must have been some stress in the war room. Can you like explain, like as a real-time, like a war room story, what was happening? How did you manage? And like, as far as we know, you did not lose a single dollar. So that's something to be very proud of. So we would like to know and tell our LPs like what exactly went through.
Yeah, I wish I had a more interesting war room story, but I was actually stuck on a flight from New York back home with no Wi-Fi, so I had to actually refresh things when I was landing, and had seen that the world was quite different from when I boarded the flight. I think it might just be helpful to sort of set the context as to why it's important, or like our reliance on exchanges, and why those two events are quite meaningful. So part of the yield mechanism that sits within Athena's product is what we sort of call a tokenized basis position. So you can really think about this as, in order to create a dollar that isn't backed by treasuries, you can go long $100 of Bitcoin, and then you short the derivatives at the same notional. And so if you're long on one side and short on the other, those two pieces cancel each other out, and you can issue something that's pegged to $1 on the other side. The issue with that is that you're taking credit and counterparty risk to all of the exchanges that exist within crypto when you're putting on the hedge position on the other side. And in doing so, you're obviously exposed to what's happening on those venues. I think one of the key changes in market structure that you actually saw from last cycle, which really enabled like the why now for why Ethena can actually exist, where it couldn't really last cycle, was a maturation in the market structure where you can actually hold collateral outside of centralized exchanges now in institutional grade qualified custodians. And so what you're able to do, and for anyone who's sort of like traded within TradFi, this is kind of how things normally work, and it's quite an abnormal situation that you actually had sort of custody, execution, and settlement all jammed together within crypto venues. And so what Ethena did was actually isolate, actually holding and custodying the assets from the exchanges themselves, so that you could always hold the collateral and never actually have exposure to holding those dollars on the exchange. So yeah, we obviously went through those stress tests. I think this market meltdown that you saw a month ago was a particularly interesting one because no exchange actually lost money. No one could actually give a reason for what happened. But you saw some coins are down 80% in a few minutes, and like really the derivative market melted down for all intents and purposes. We saw, I think, around $40 billion of open interest wiped out in that 24-hour period. I think the interesting thing about the product is that it actually benefits from those market dislocations, because in the mechanic that I was describing to you in the beginning, where you're long Bitcoin on one side and then you short the derivatives on the other, you tend to see in these market destruction events, actually derivatives are trading below spot because people are getting liquidated from being long on leverage on derivatives. And so as they're getting liquidated, the derivative is actually trading below spot while that's happening. And so if you've gone into that position delta neutral, you're actually picking up additional P&L while that happens. So I think everyone sort of saw things melting down, but the truth in reality, while I was stuck on a flight with no Wi-Fi, was that we're actually making more money when the whole thing was sort of unfolding, because that short position had a larger P&L than you expected it to.
All right, so not only did you not lose money, but you actually made money.
Yeah.
All right. That's crazy. Another thing about Ethena is like the basis trade that Ethena has relied on so extensively over the last year or two is restricted to crypto capital markets right now. So I'm sure people have asked you, how do you think about the size of Ethena opportunity at large? Is it restricted to only Binance, Bybit, some crypto exchanges, or is there a vision beyond this? So it would be great, like just for you to outlay your 1 year, 3 year, maybe 10-year vision on how Ethena scales from here till there.
Yeah, for sure. I think the macro market that you're going after, right, is kind of like the euro-dollar market. It's not a small one. It's like 20 trillion plus of dollars that exists outside of the US that you're trying to provide people access to. And I think in a lot of the estimates that you've seen around like stablecoins, dollar-pegged assets, and their growth profile going forward, estimates are in multi-trillions in the next few years, and I think that's pretty consistent with how we view the world. And I think actually the category of yield-bearing or dollars that actually carry some sort of return is actually going to go faster than the entire market segment itself. And so I think we're operating in a space where stablecoins as a whole probably go from 300 billion to 3 trillion in the next 3 to 5 years. But actually the yield-bearing category of that, I think, grows 10 times faster than the entire market itself. And so I think just operating within that space, these are going to be very extremely large numbers, where I think yield-bearing stablecoins as a percentage of the entire total probably evens out around 100 to 200 billion dollars in the next few years, which is obviously quite a distance from where we are right now. In terms of the actual basis mechanic that's sitting within USDE, the derivative market within crypto is actually abnormally large, and I think people don't appreciate quite how big it actually is. So there's only really 3 $10 billion plus cash flow opportunities within crypto. So for everything that we've built and tried to build in the last 10 years, there's actually only 3 things that have produced $10 billion plus cash flows. It's Binance equity from trading, speculation, and sort of the casino type activity that you see. It's Tether equity from tokenizing a dollar. And then it's the basis within the futures market. So the futures market, derivative market, is around $100 to $150 billion in size and pays an annualized roughly 10-ish% on that 150. So we are talking about one of the largest sort of cash flow opportunities that exist within the space right now. But I think the broader piece about what we're excited about is actually the growth of perpetual swaps more broadly, I think, is actually one of the few key innovations that have come out of crypto that are actually just outright better than what you see within traditional finance. So for anyone who doesn't know what a perpetual swap is, you can really think about this as a future or a dated future that doesn't have an expiry date, but it keeps its price in line using a mechanic known as a funding rate, which is essentially an interest rate that tethers the price of the derivative to the underlying spot. I think that actually taking this perpetual swap, which is really popularized around crypto assets, but then generalizing it to any asset that you want to express a delta one opinion on, which is anything that you can represent with a number, is actually going to be one of the biggest growth stories in finance, full stop, in the next few years. I think one example here, if you look at leverage speculation from retail on Robinhood, do I think it makes sense that a lot of the flows that you see on derivatives are on options for retail speculation on Robinhood? I don't actually think that makes sense. When you're buying an option, you're expressing a view on volatility, you're having to underwrite Greeks. You're not just saying, I want to get long this stock at 10x leverage and that's it. And I think perps are actually a much more efficient instrument in order to accomplish that. So I think in the next year to two, you're going to start seeing the perpetual swap taken out of crypto and actually applied to every single asset that exists outside of it. And really, even if you take that one example there with equities, you're expanding the TAM for things that could be put into something like USDE from $3 trillion of crypto to $120 trillion of equity that sits outside of the space right now. So yeah, I think part of the growth of Ethena goes hand in hand with what I view to be one of the most exciting sort of developments, which is the perpification of everything that exists outside of crypto as well.
Sounds good. There are different business models that different stablecoin issuers are going around. Can you talk about if you see there are more than just a couple of business models that are obvious at this point for stablecoin companies and DeFi at large, if they want to interact with DeFi?
Yeah, so I think in many senses, I think people have maybe over-indexed on the success of Tether as a business model, and they're extrapolating their success going forward for all stablecoin issuers. So I think it's no secret that Tether is one of the most profitable companies on a per headcount basis, and I think will actually become one of the most valuable companies on earth in the next few years. But every single fiat stablecoin issuer that's come after Tether is definitely not the best business model that you've ever seen, because margins have actually been driven pretty aggressively down. And part of that is because the product is commoditized in the way that I was describing in the beginning. I think one of the most interesting qualities of Ethena's product and Ethena's business is that it actually has a negative correlation to Fed fund rates. So what we saw, as just one example from last cycle, was that when interest rates fell, which is obviously the core bread and butter of how a normal fiat stablecoin issuer is actually generating revenue, we tend to see that actually interest rates within crypto go in the opposite direction. And the reason for that is that actually when interest rates fall, people speculate more on the long tail of assets. So you see ZERP type behavior, whether it's GME speculation on Robinhood, all the stuff that we saw in 2021. Generally, the demand for leverage and speculation is positively correlated to the rates that you see on Ethena's product. And so actually, in many ways, the macro interest rate environment that we're seeing now with interest rates coming down is kind of the perfect setup for what Ethena is doing, which is we actually think the rates in our product will expand as our competitors are sort of falling. And that allows you to obviously extract more as a business, or it allows you to grow more aggressively as their hands are tied with a product that comes down. So I think you're kind of seeing that reflected now in the way that Circle has been trading the last month or two, which is there's a lot of sensitivity around what happens when interest rates go down 50 or 100 basis points from where they are now for these normal fiat stablecoin issuers. Aside from just like the NIM management, so stablecoins kind of look like banks in many ways. You're borrowing, and the liability is just the stablecoin, and then the assets are like the treasuries that you're deploying them into. It's a very simple, narrow bank. There are some, you're seeing some of these businesses expand to try to do, chains, payment settlements, all that kind of stuff. But I think sometimes they run the risk of actually just like competing with the people that should be their customers as well. So if you look at a chain, for example, like Arc with Circle, a lot of the people that they're actually looking to undercut there should also be potential customers that are using USDC, and there's a natural like tension that's been created over there. So even though I think issuers will try and do a bunch of different business lines that sit around the core NIM generation that I was describing, I think that's always going to be the bulk of what they of where they generate the revenue. Yeah.
Cool. What are some of the long-term growth opportunities that you are excited about at Ethena, like beyond just being a stablecoin only?
Yeah, well, I think that is still a very big opportunity, and I think we've still got like a lot of wood to chop there. As I said, I think where we're sitting now, product peaked at around $17 billion. I would like to grow that number to like north of $100 billion in the next 3 to 5 years, and that's going to be a big job to get done. I think actually Spencer's presentation that he did earlier today, I thought was actually brilliant when he was describing the sort of 4 phases of fintech evolving and how we're kind of entering this new phase that actually finance and fintech can be built on stablecoin rails underneath. And I think that actually, even if you look at the financials of how a business like Revolut, for example, generates the revenue, 65 to 70% of the revenue is actually still in that NIM generation business, which is actually just core to what you're doing with a stablecoin. So I think there is an opportunity to actually pick up what we have with the core product, which is a structurally higher return on dollars in a savings product, and actually packaging that in like a consumer-friendly neobank type experience that you can actually take direct to consumers. So I think that that's just like a huge opportunity there to sort of rebuild a mobile-first experience for consumers and have that running on like the full stack that you control with stablecoins in the background. Yeah.
Great. All right. 2 questions to end the conversation. What is one thing that you think is very overvalued in the stablecoin space right now? Overhyped. Overhyped, sorry.
Slightly less contentious.
Everybody talks about stablecoins. Like, what's the overhyped thing?
Yeah, I kind of touched on it earlier. I think the business model for normal fiat stablecoin issuers, except for Tether, I think is a little bit overhyped. And I think in a post-Genius world, the margins for these businesses are going to kind of converge to asset management type businesses where you're just making 15, 20, 30 basis points on AUM, not 400 like they have in the past. And so I think that core business model is quite challenged going forward for people that can't differentiate the product. Yeah.
All right. And the last question, what do you think is the most undervalued thing, underhyped thing in the stablecoin space and people are not actually giving too much attention to it, which they should?
Yeah, I think, I don't know, underhyped or undervalued or maybe just like underappreciated. I think I've had some of this experience trying to like deal with regulators in Europe, and I think one piece that people don't appreciate is actually how geopolitically important like this asset is actually just going to become to the way that governments and countries interact with each other going forward. If you think about the function that a stablecoin is actually causing on a country or a banking system, is that a euro is leaving a commercial bank and coming into a dollar, right? And that has actually 2 impacts which are really important. One is that it destroys credit creation within the economy because all credit is created through commercial banks, and actually lending and credit is actually contracted as a result of that. And then the second implication is that the euro weakens versus the dollar because you're selling euros and buying stablecoins on the other side. And these are 2 pretty important pieces, right? It's like the beating heart of your entire like economy is like commercial banks, and then the currency is the thing that you care about, if not more importantly than banks themselves. And so I think like this can get pretty ugly at a certain scale, where if we're talking about the numbers that Scott Percent has actually referenced, where these are like $3, $5, $10 trillion in size, that's actually going to cause a lot of damage to like banking sectors and currencies that exist outside of the US. And I wouldn't be surprised to see like extreme currency control type of retaliation that comes out as, as a response to that. So I think the thing to just be appreciative of is that there's probably going to be a lot of geopolitical like conflicts that actually result from the growth of this asset. Yeah.
All right. Cool. Thank you so much for your time. Thank you, guys.
Appreciate it.